Gas pricing across the former Soviet Union has evolved significantly in the recent past. During the Soviet era, gas was mainly traded as part of wider barter agreements between former Soviet republics. After the dissolution of the Soviet Union, the newly independent countries started reforming their economies and introducing market-based principles. However, the question on how to price gas remained unresolved, and no pricing formula existed. Prices were set through annual intergovernmental agreements, which handled a wide set of issues, such as transit tariffs, ownership of transit routes, depths, and volumes. The complex nature of these negotiations often led to stalemates and political posturing at the highest levels, in some cases even to supply interruptions. Gas trading in Western Europe, on the other hand, is regulated by a pricing formula which was developed in the 1960s with the introduction of gas to the European energy market. For gas as a new energy form, the challenge was to gain market share from more established fuel oil products. Thus, the solution was to link the price of gas to that of oil products, allowing gas prices to move alongside oil prices and thus remain competitive. As European prices increased in line with the surging oil price in the last few years, the gap between European and CIS Baltic prices increased. From Gazprom's perspective, this uneven development meant that the company was effectively subsidizing the economies of the CIS Baltic states and losing income. The Russian gas monopoly's aim became to seek an equal yield from all of its markets. Thus, it sought to push prices in the CIS Baltic market to European netback levels. This strategy was at odds with the interests of Belarus and Ukraine, who obviously would prefer to keep prices low. Both are important transit countries for Russian gas to Europe, and both have used their control over export pipelines as a bargaining tool. The January 2009 gas dispute between Gazprom and Ukraine is as a result of these conflicting aims. However, by March 2009, Gazprom had secured agreements with most CIS Baltic countries on a gradual transition to European netback prices. In January 2009, European netback prices were also introduced to gas purchase contracts between Gazprom and Central Asian gas exporters. As gas suppliers, Turkmenistan, Kazakhstan, and Uzbekistan have long eyed European price levels, which even when adjusted for transportation costs, have historically been considerably higher than the amount they received from Gazprom. This was mainly due to the fact that the bulk of Central Asian gas exports was resold to Ukraine way below European price levels. In an attempt to outplay competitors seeking Central Asian gas, Gazprom started to pay close to European netback prices to Central Asian exporters in 2009. This move has secured Russia the lion's share of the region's gas wealth and cemented its position as Central Asia's main gas export route. The new pricing agreement with Central Asian suppliers had an immediate impact on the price Gazprom sought from Ukraine, and ultimately pushed Ukraine's gas price towards European netback prices. Following these developments, we can see how gas prices from Central Asia to Eastern Europe are moving towards European netback prices. The linkage to European prices will remain attractive to suppliers and ultimately consumers, and progressively take on a bigger role. It provides both parties with a stable and transparent framework for their long-term gas trade, thereby moving away from arduous annual negotiations.